Once again, we had a mixed night of trading in the US. The Dow Jones Industrial Average finished flat in trading overnight, but the S&P 500 was down by 0.5% and the Nasdaq was down by 1.2%. And those falls echoed some of the moves that we saw around the globe, but were a contrast to the experience in the Asia Pacific region yesterday, where, for example, in Australia, we saw a rally of just over 0.5%. But the market action at the moment is still dominated by individual stock moves, and the volatility in individual stocks has been remarkable, particularly through the earnings season. And that's, in most cases, what's driving these big changes. So in Xero, we saw a gain yesterday of 8.6%. ProMedica overnight was up 10%. Nvidia up down 5.5%, and CRM up 4%, all in response to company-specific news. And these big swings in markets seem to be representing the shift that we've seen over the last 10 years, the move away from active investing and from value-based investing into index investing. And that means that when news comes out that is stock-specific, the stock can make very big moves. Now, that sort of risk-off sentiment that we saw with that pressure on the Nasdaq was repeated across markets. Gold futures touched levels above 5,200 again. Bitcoin was under pressure, down around 0.75%, but at $67,500 US. It's not looking good, particularly on the charts. We've got US jobless claims tonight, something to look out for, with the US Federal Reserve's mandate being split between the need to manage prices and employment. Employment data becomes more and more important. So although we generally don't focus too much on the jobless claims, they could have an inordinate impact on the market in trading tonight if they are well away from fairly modest expectations. Earnings are still the key to the market. Today, after the close, we've got Coles, Virgin Airlines also reporting. Virgin reported this morning and have put a end to the tax losses that came out of their administration. Underlying profit was very pleasing, up more than 20%, and Virgin likely to gain some support in the market today, following on from Qantas's reports. And while airlines globally remain a very tough and low-margin business, it's pretty clear the operating environment for Australian airlines, while the duopoly continues to stand, has been pretty favourable as markets and economies have recovered. And the surge we're seeing in earnings at both Qantas and Virgin does suggest that there is some pricing power coming back into airlines and airline services. So we'll be looking out for Coles after market, after Woolies. Big result on Tuesday that saw markets surge and Woolies shares up by double-digit percentage gains at one stage during the course of the trading day. If Coles can repeat the sort of result that Woolies delivered, we could see similar gains on Monday. But the focus this morning is ETFs, and one of the reasons for that is we've seen record inflows in 2026. In January, 156 billion flew into US ETFs, and we saw another 51 billion in international ETFs on the US exchanges. So those more than 200 billion flowing in suggests that investor confidence remains high, and it points to the longer term trend that we're seeing in markets towards ETFs. Now, ETFs are very diverse, and some of them have high leverage and other aspects that make them high risk vehicles. But in the main, the economic argument for ETFs remains very strong. The ability to purchase, exposure to a basket of shares in a single purchase with the lower costs that entails has become economically compelling, and it's very clear that ETFs now play a very important part in many portfolios, not just here in Australia, but around the world. So we're seeing people expressing various views about the markets in their purchases of ETFs. Precious metals, semiconductors and tech ETFs have outperformed major equity indices over the last 2 months. And we're seeing materials up 27% and energy up 20%. And those ETFs that are exposed to those thematics are amongst the best performers year to date. So in Australia, State Street's ASX 200 has tracked the index higher, up 18% year to date. And in the US, the iShares Global Silver Miners ETF, for example, is up 29% this year alone, adding to the gains that we saw last year. So the economics of investing in ETFs seems to be coming to the fore, and investors are embracing the ETF investment option as we see in the market and in the turnover figures and in those record flows into ETFs so far this year. We've got a number of stocks on the watch list today, of course, with earnings coming out. Block earnings are out this morning. It's unfortunately reported a drop in earnings of 21% year to date. The stock is down. We're seeing profits coming through, but the layoff plans seem to have dominated the news. Block have announced that they're going to lay off up to half of their staff. And generally speaking, markets like to see costs being cut, so we could see a very positive response today in trading for Block. Ramsay was up 10% yesterday, taking its year-to-date gains to 22%. It's had a profitable first half. Income was up almost 10%, and profits up a little over 6%. Some concerns from analysts around that, what appears to be some margin compression in that growth, but nonetheless, growth in revenue and profit is always generally good news. A stronger Aussie dollar has helped them out, but a weaker euro has not. And their earnings need to keep growing in the second half for it to maintain any sort of share price momentum. Intuit is also reporting tonight. Now, this one's had a very volatile run into its result, and we could see a very volatile response when Intuit releases its results tonight. Intuit, of course, is a provider of QuickBooks, amongst other software as a service provisions, but QuickBooks probably the most famous. Now, so far, Intuit shares have been under extraordinary pressure, down 42% so far this year. Now, in the last 24 hours, the trading in Intuit has been extraordinary. It was up 3.5% initially during day trading. It's now down more than 6% in after-hours trading, and it does appear that the response to the result will be a key driver for shares.